Hey everybody, it's Misty. I wanted to pop on and send a quick video out today. I was about to write a big blog article or email, and there's so much going on and it's happening so quickly that I thought what I should do is just talk to you right now about what happened last week, what's happening right now, and some action steps that I think you should do if you feel the need to take action. Some of you might be like, what are you even talking about? That's okay. Don't worry. There's no reason for everybody to panic, but I want to talk about panic quickly. So last week, Silicon Valley Bank, which is a large bank in California that basically helped fund, it was basically a venture capitalist bank that helped fund a lot of tech startups, tech healthcare startups, a lot of great companies, a lot of brilliant ideas, and a lot of good comes from tech startups or startups in general. I'm a huge fan of small businesses, and but they're not traditionally the most desirable companies to lend to. So what this bank did basically was lend to people who were maybe a higher risk than some traditional banks might have wanted to take on. And so, this bank's been in existence for, over a decade. And what happened last week was one of the larger investors wanted to take their money out. Now, here's why a, you know, a large investor might want to take their money out. So this banking environment, so we've seen interest rates have been continuing to rise. Now, tech was doing very well for the past decade in a low interest rate environment. That meant money was very inexpensive. If you were in real estate, like money was very inexpensive when you're borrowing money at super low interest rates. And so how banks make money is they keep some of their money in a safe or in the bank, and the rest of it they're lending out. And so they're making a profit, and that's how they're able to pay interest to their customers. And so when the interest rates rise, banks that are invested in, say, long-term treasuries, then those start to lose value. The stock market being in decline, which is where the banks had some of their investments, lose value. And also this bank, Silicon Valley Bank, is very heavily invested in tech startups, which were, losing value. So they were kind of not super diversified as far as their client base was concerned. And also now the amount of speed that information travels at is way faster. Like if you think about a classic bank run, if you've ever seen the movie It's a Wonderful Life, that's where they say, okay, their money's not safe in the bank, go get it out. And everybody comes into the bank and is asking for their money. That's not how banks are designed. But if a large investor says they're taking their money out and other investors get wind of this, they're going to rush in to get their money out too. Now, FDIC is an insurance program, the government that took over on Friday. And so what FDIC insurance does, and most of you might be aware of the term, it basically insures $250,000 per depositor per insured bank for each ownership category. So if you have $250,000 at Bank of America in a checking account in your name, and you have $250,000 at Citibank in a bank account in your name, both are covered. If you have $500,000 in your name alone at Bank of America, $250,000 of that is covered. If it is a joint account, $500,000 of that is covered for you and the other insured. So FDIC insurance is nothing new. It is not it's been around, and most of us are under that as far as our cash positions per account. But if you're somebody who's maybe inherited money, maybe you have sold property, or you've just been piling cash into a savings account, maybe since the pandemic, you may be over those limits. So that's something that I'll talk about later, but those are the limits there. And so that's what the investors at Silicon Valley Bank were covered up to. A lot of their clients had way more than that. And so they were exposed. Today, President Biden stepped in and said that those investors, those customers would be made whole. They would have access to their money. These customers need to make payroll. They need to run their businesses. And so this is good news for them. Now, what this means for you, well, a couple things. And first, I want to say that I don't want to just tell you not to panic because it's not helpful, but it is how I feel. I have talked to a lot of you about this in the past, but I've been in situations that were very terrifying financially growing up. And so I understand what it is actually like to really be out of money, like really out of it. And so I kind of was like raised in a very high stress, high panic environment financially. And I'm still here. I made my way out and work with you now, but I understand panic. And I've just been so exposed to it. It's almost like if you're one of my clients who's a nurse or fire or police, where you might just be exposed to these crazy situations so frequently that you're kind of calm in them, or you can make better decisions than everybody else around you who's losing their mind. There's plenty of situations where I lose my mind. I hate heights. I'm afraid of the dark. And also the sight of blood. I could never do what half of you do for work because I panic. I don't make good decisions. I act crazy. And but money is not one of those situations. I can look at this and say, okay, this is what's going on right now. This is why it happened. This is why it's similar to 2008. This is why it's not similar to 2008. Our portfolio right now is pretty well positioned, even though it could be down short-term volatility. I still like where we are. I know that at some point, maybe I will swing back into financials. Maybe I will swing back into tech, but it's not right now. And I'm okay looking at where we are. And I'm going to continue to invest. I am not going to panic. Panic selling is a bad idea. So going back 14 years ago, like last week, the 9th, March 9th, 2009 was the lowest close during that bear market. Since then, as of March 9th this year, the market, the S&P 500, rallied 490%. So a $10,000 deposit that day would be worth $59,000, not including dividends, 14 years later. That's an annualized return of 13.5%. Now, there are plenty of people that sold on March 9th or March 8th or March 7th or March 1st, 2009 that thought they were making the safe decision because they panic sold. They didn't know if it was going to get worse. They didn't know it was going to turn around and get better and shoot back up for the next 10 years. So they acted and they did what they thought was right. And I feel for those people. You may understand, you may have been that person, but overall, capitalism is hard to kill. COVID didn't do it. The 2008 crisis didn't do it. This is not going to do it. Silicon Valley Bank, it's not going to do it. The government stepped in Monday, today, and said they would make everyone whole above FDIC insurance. So I don't believe that this is it. But what I do think, especially if you feel like you want to do something, like sounds good, but I'm still freaking out, I get it. First thing I want you to do is check your bank accounts. Make sure they are an FDIC insured institution, and make sure that if your balances are over $250,000 in any particular account, how it's titled. If it is a joint account and if it is over $500,000, then what we might want to do is open another account in another institution and maybe make sure that we spread out our bank deposits to spread that risk out. If it's under 250, it doesn't matter. You don't need to do that if you have up to the 250,000 coverage or joint coverage. But if you have more for whatever reason, I think that could be a smart decision. Also, check your emergency fund. How much cash do you have on hand right now? Do you feel like you could get through the next 3 to 6 months, even if there's volatility? And if you can, great. I think that is a good thing. If not, we could talk. Maybe there's something that you want to do. Maybe you do need a little more liquidity right now, and I understand that. We want to see how much do you spend in a normal month, and can you cover it? Also, spend carefully. This isn't the time to go big or to, spend carelessly or to take on debt not, everyone needs to take on debt sometime. I understand that, but do it thoughtfully. Do it thoughtfully. Make sure you understand what you're doing, why you're doing it. It's not necessarily an impulse decision. And keep investing. If you're somebody who's investing in your 401k or you're investing with me, I would say that you continue to invest in down times. This is when you would be buying low. And this reasonably is a good thing, but it is very hard to do. It feels wrong. I understand that. But it's true if you look at when, I'm interested to see how much Warren Buffett invests in March of this year. I have a feeling it's going to be a lot. And so we'll see. But keep investing, stick to your plan. And also, though, if you're heavily invested in your own company, say they pay you your paycheck, which is obviously you're very well tied to them in that case, or if you are heavily invested in their company stock, you might want to consider diversifying that risk. We don't know when these things happen to individual companies. As of last week, I think there was something celebrating this bank on like Monday as being one of the top banks and awards and things like that. So I mean, this is kind of a quick situation, but information travels faster than it ever has, and so it doesn't take much to, so diversifying your risk, I believe, is always a smart thing. So you might want to think about options as far as your investment in your company stock and potentially diversifying that among other companies, sectors of the economy and asset classes, just to kind of spread it out. If you're invested with me, we are not in a very concentrated portfolio. I am in certain sectors. However, those, particular holdings that we have include, lots of different companies. So we're spreading that risk out. But if you're in one company and their company stock, it is a more concentrated level of risk. So that's something to think about. And as always, if you feel like you need to just take action and do something, that can be setting up time to talk to me. And that is action. And we can talk about this. And I will be the first person to admit that I understand what it's like to be freaked out. I don't like seeing our accounts down. I think the market is actually popping back up today. But I also don't feel like this is a long-term place or this is the time to make rash decisions. But I'm always happy to talk about it because I understand, like, sometimes when I get more information about what I'm doing and why I'm doing it, I feel better. So feel free to always do that. But yeah, check your bank accounts. Check in with me if you need to. And otherwise, I believe this is just going to be an interesting case study at some point in the banking industry. There could still be some fallouts. So yeah, make sure you've got that coverage. And yeah, please connect with me if you feel like you need more support. I'll continue to look out for your best interests and be here when you need me. Thanks.